Hello everyone, welcome back to our channel. Today we have an exciting topic to dive into.
You know, when we think about cricket, everyone talks about hitting a massive six, but what's the real skill of a great batsman? It's knowing which ball to play, and more importantly, which ball to leave alone. And you'd be amazed how this one idea, the art of waiting, can completely change how you approach the world of trading. Look, in cricket, if you try to smash every single ball for a boundary, you're going to get out fast. It's exactly the same in trading. If you try to jump on every little market movement, every single candle that pops up on the chart, you're going to burn through your capital even faster. So today, we're going to learn how to trade like a pro cricketer, with patience, with strategy, and with discipline. All right, here's our game plan. First, we'll dive deep into this connection between cricket and trading. Then, we'll tackle the biggest enemy for every new trader, and that's FOMO. After that, we'll learn how to read the market just like a captain reads a cricket pitch. And finally, we'll put it all together to build a winning, disciplined strategy. Let's start with what I think is the most important skill in both of these fields, the art of waiting. Seriously, the greatest players, whether they're on the pitch or on the trading floor, they get that most of the game is about knowing when not to play. You see, a clever bowler will often throw a wide ball on purpose. They're trying to tempt the batsman into a wild swing, hoping they'll get caught out. A smart batsman? They just let it go. In trading, a choppy market is that exact same trick. It's a messy, indecisive period, and trying to trade it is the fastest way to lose your money. The first lesson is super simple. Don't swing at the bad balls. So why on earth do we swing at those bad balls? Well, this brings us to the biggest psychological trap in trading. It's a feeling that gets almost everyone when they start out. FOMO. You know that feeling, right? FOMO is that little voice in your head that's screaming, hey, the market's shooting up. If I don't buy right this second, I'm going to miss out on all the profits. It's a really powerful emotion, but when you act on it, you're acting out of fear, not strategy. It's what makes us jump into trades without even thinking. And this is where the cricket analogy just hits home perfectly. When you give in to that FOMO and trade in a bad, choppy market, you are, for all intents and purposes, swinging at that tricky wide ball. The result is exactly the same. In cricket, you lose your wicket. In trading, you lose your money. So, what does this bad ball actually look like on a trading chart? Well, we call it consolidation. This is when the price isn't really going up or down in a clear direction. It's just bouncing around sideways in a messy, unpredictable range. This is the exact market condition where your only job is to be patient. Sit on your hands and wait on the sideline. Okay, so if we're supposed to avoid those choppy markets, when do we actually trade? To figure that out, let's stick with our analogy. Just like a cricket captain before a match, our first job is to read the pitch. Before any match, the captain gets a pitch report, right? They need to know if it's going to help the batsman or the bowlers. That one piece of information decides their whole strategy. In trading, our pitch report is the market trend. We have to know if the market is going up or down before we even think about placing the trade. The trend is just the overall direction. And for the strategy we're talking about today, we are on the lookout for an uptrend. I want you to think of an uptrend as a perfectly flat, beautiful, batting-friendly pitch. It's the absolute ideal condition for us as buyers to step up and score some runs. So how do we spot this perfect batting pitch? Well, I'm going to teach you a really simple technique. It's called the Zig-Zag rule. It's a super easy way to visually confirm if the market is really and truly in an uptrend. See, the market never just shoots up in a straight line. It moves more like a staircase. So let's break down this zigzag rule into 4 simple steps. Step 1, the market makes a high point, or ucham as we say in Tamil. Step 2, you patiently wait for it to pull back and make a low point, or pallam. Now for the important part. Step 3, you watch for the price to break above that previous high, creating what we call a higher high. And the final confirmation, step 4, is when the next dip creates a higher low, a low point that's still higher than the previous one. This stair-step pattern, that's the green light we're looking for. So once you've spotted this beautiful uptrend, this perfect batting pitch, what's your bat? In the world of options trading, it's a call option, or CE for short. This is the tool you use, the instrument you buy, when you predict the market is going to continue its journey upwards. Okay, so we've identified the right conditions. We know we're on a batting pitch. But that's only half the game, isn't it? The other half is all about execution. It's about timing your shot absolutely perfectly. So this is the million-dollar question, right? Just because the trend is up doesn't mean you can buy at any random point. A professional batsman doesn't just swing wildly. They wait for that perfect delivery. Our job is to do the exact same thing. So when do we swing the bat? We wait for something called a pullback. Now, a pullback is just a temporary little dip in the price during a strong uptrend. It is not a crash. Usually, it's just some early buyers taking their profits, which causes the market to pause and catch its breath before the next wave of buyers pushes it even higher. And this is the perfect cricket analogy. The pullback is the loose ball. It's that easy, hittable delivery that you've been patiently waiting for. So here it is, your simple 3-step batting strategy. Step 1, you confirm the uptrend is still going strong with that higher high pattern. Step 2, you patiently wait for the price to pull back to a key support level. And step 3, and this is crucial,
இந்த
don't
வீடியோ
jump the gun.
உங்களுக்கு
You
பிடிச்சிருந்ததுன்னா லைக்
only
பண்ணுங்க,
enter the
ஷேர் பண்ணுங்க,
trade
சப்ஸ்கிரைப்
after you
பண்ணுங்க.
see a
Thank you for
green
watching.
candle form at that support level. That's your confirmation that buyers are stepping back in. And what exactly is support? It's simply a price level where, in the past, the market has stopped falling and bounced back up. Just think of it like the hard ground of the cricket pitch. You know that when the ball hits that spot, it's very likely to bounce up again. That's our high probability entry zone. Now, when you actually go to place the trade, you've got a choice. A market order is like closing your eyes and just swinging the bat wildly. You'll buy at whatever the current price is, which might not be great for you. A limit order, on the other hand, is the professional's choice. It's like telling your broker, hey, I will only buy at this specific price or even better. It's all about calculated, precise shot selection. Finally, and listen, this is absolutely non-negotiable. You must use a stop loss. A stop loss is a preset order that automatically gets you out of the trade if it moves against you by a certain amount. I want you to think of it as your helmet. You put it on hoping you'll never need it, but if a fastball comes flying at your head, it's going to save you from serious injury. A stop loss protects your capital from a catastrophic loss. So let's wrap this all up. The real goal of trading, just like in a long test match, isn't to hit a boundary on every ball or to trade every single day. The number one goal is to protect your wicket, to protect your capital. You win by surviving the tough periods and then taking full advantage of those easy, high-probability shots when they finally show up. Please remember this. A big win feels amazing, for sure, but the real victory is ending the day with your capital safe and sound, ready to play again tomorrow. True long-term success isn't just about aggressive offense. It's built on a solid foundation of defense, discipline, and a whole lot of patience. So, what's the one thing I want you to take away from all this? It's not just a strategy, it's an identity. I want you to adopt this mindset. I want you to tell yourself, whether it's in English or in Tamil as you see it here, I am a disciplined trader. Make that your personal mantra, because in the end, it's not the market that decides your success. It's the discipline you build within yourself.
இந்த வீடியோ உங்களுக்கு பிடிச்சிருந்ததுன்னா லைக் பண்ணுங்க, ஷேர் பண்ணுங்க, சப்ஸ்கிரைப் பண்ணுங்க. Thank you for watching.